Coming up on the SBS On the Money podcast, inflation eases more than expected, so the chance of an interest rate cut in February is boosted, and the ASX nears a record high. All that next. Hi everyone, it is your daily 10-minute business and finance news wrap for this Wednesday, the 29th of January 2025. The Australian share market almost reached a new record closing high, up 0.6% for the S&P ASX 200. We'll have the details with Matt Sherwood from Perpetual in a few moments, including his reaction to today's inflation report. The ABS says annual inflation eased to 2.4% for the December quarter, while the underlying rate also eased to 3.2%, approaching the RBA's target band of 2 to 3% and increasing the chance of a February interest rate cut. For more, I spoke with Micaela Fuchila, Chief Economist at Jarden Group. Micaela, first of all, today's inflation read, does it increase the chances of a rate cut in February?
Yes, I was actually surprised by the underlying measures declining by more than we have expected. And it actually shows that there's very little pressure from the demand side of things, which means a cut is way more likely in February, considering the RBA has shifted to a more dovish stance at the November meeting. So it opens the window for a cut, certainly.
Okay, can we break down all the numbers though, right? Firstly, I saw in one of your previous notes that you said that the housing component is a key driver of inflation pressures. What does the data out today say about that?
So actually, it was quite surprising that it declined for the first time in about 4 years. So we saw the whole housing component, which includes rent and purchases of new dwellings, that all went down by 0.2. Which is the first decline that we've seen in a while. It responds to the weakness in the construction sector, which actually reflects the traction from monetary policy being a lot tighter.
What kind of impact have government rebates had in general?
Yeah, so that was significant again at the headline level. This is the second consecutive quarter where we see a very large decline in electricity prices. That was one of the ones that was impacted by electricity rebates, both from the state level and also the federal level. There was also some rent assistance, which contributed to that decline in the housing component I was talking about before. So they're still coming through, and they will still be in place. Our expectation is for these subsidies to be removed in the second half of this year.
Where else are cost pressures easing?
So it's interesting. It's kind of very narrow base where we've seen the inflation pressures remaining sticky. So we've seen insurance prices coming up. We also saw a little bit of increase in tobacco and alcohol due to excises. So there's really naturally a broad-based decline in inflation that's driven by demand. So that's a very positive one. In terms of where are pressures easing, pretty much everywhere. We did see though two things in this quarter that are like good luck. One is petrol prices went down. The second one is the decline in in transport, which reflects, of course, the petrol prices as well. And there's a few increases on the tradable side, which we haven't seen before. So the recreation component was actually up in the quarter, and that's on the back of domestic travel and accommodation, which reflects demand over the holiday period. And the second component that we were seeing a little bit of a decline is in the household goods side, which reflects all the discounts that we've seen throughout Black Friday and ahead of the Christmas period is normally heavily discounted. But that's not surprising for the RBA.
What I found interesting too when I looked through today's data is a chart comparing goods inflation and services inflation, right? We know goods inflation is now at its lowest since 2021, but services inflation remains sticky. I think you mentioned some of those costs coming down. Overall, they're coming down, but I think rents are still somewhere like 6.4% higher for the year.
Yeah.
Inflation's 11. Insurance is up 11% for the year. You've got medical and dental up about 4.2% for the year, right? Is this a sign that the overall easing of inflation isn't so clear cut? And what other signs are there of that?
So I think that the main reason why services are staying sticky is the strength in the labor market. So those services are actually quite reliant on labor. Labor cost has remained elevated relative to what we are used to pre-pandemic. So that's actually flowing through inflation as well. In saying that, it has eased as well. It just hasn't eased as fast. The insurance is a particular one because it has, a review of policies on an annual basis, and sometimes that can boost the rate. And that's what's easier to see or look more in detail on the underlying measures rather than the headline, because they get really impacted by those. But in saying that, the outcomes this quarter are actually the lowest in 4 years, so it's quite encouraging.
You mentioned labor costs and labor. That's one of the final points I want to make, because we know that Australia's unemployment rate is still relatively low, right? And this inflation number is just potentially the final piece of the puzzle before the RBA meets. But what else is there that the RBA will need to consider when looking at rates? Because as I mentioned, just how important is that jobs number still?
It is very important. Remember, the RBA has a dual mandate. They have to try to maintain those labour market or employment gains they've made. To be honest, if you look back before the pandemic, it was really hard to get unemployment below 5%. So it's kind of a positive thing, taking all the data at face value. In saying that, it can put pressure on labour costs, especially on the small business sector. They still have seen major problems to find labour, the availability of labour in regional areas. That's pushing labour costs higher. So when the RBA meet, they're not going to take the inflation data in isolation. They have the rate has been kept at a peak for over a year now. And what we have seen in terms of traction is growth actually went down to almost zero, so 0.8 year on year, driven mostly by the public sector, showing that the private sector is not really hiring on investing. That's the first thing they're going to look at. The second one is the unemployment rate is low relative to history. They will try to preserve that as much as they can. And that's also come back from 3.5. So it did come back about 1.5 percentage point. So it's showing that the hiring, it's there, it's solid, but it's not as strong as it was during the easing cycle. So it shows there's a little bit of traction in there. A lot of people are arguing that there's these are public sector jobs and it's not actually genuine demand in the economy, but these are full-time jobs and they're safe. And it doesn't mean they can get cut off in a day when the private sector starts to pick up the slack. So it's actually a great scenario for the RBA to remove some of the restrictiveness and start to think about if the level of the cash rate is consistent with where the economy as a whole is, which in our view is not. It just needs to come down. But we do think there's a lot more upside risk for inflation, and that will keep them on the cautious side.
Okay, so in wrapping everything up we've just discussed today, what do you think the RBA will do in February and why?
So before we saw this inflation data, I was quite convinced that February was a no because of the strength in the labour market, stickiness in services, as we discussed. But seeing the progress on that side, I think 6 months of consecutive decline in inflation, particularly of the underlying measures, and thinking of the lags, right? There's more to come in terms of the traction from policy. I think there's a very high chance that they could go in February. Also, market pricing supports that view. We have over 90% on futures and OIS suggesting that it's a done deal. So they have a small window. We know the subsidies are going to be removed in the second half of the year, and that will boost inflation back up. Demand will be better because inflation is lower and purchasing power is better. So growth is going to be better as well. So they have a very small window to deliver on those cuts if they want to, but we don't think the economy is arguing for a need of support. It's just bringing back down rates to a level that is closer to neutral. So beyond whether it's February or May, what we expect so far is 2 cuts. And if the labour market data deteriorates further, potentially 3, but we're very conservative on that side.
That's Micaela Fuchila there from Jarden Group.
Now, Market Day on the SBS On the Money podcast.
And the share market reacted positively following that data from the ABS. The S&P ASX 200 closing stronger by 0.6% to 8,447. That is narrowly missing a record high close. So for more on that, including the reaction to today's data and what it means for interest rates, I spoke with Matt Sherwood, the head of investment strategy at Perpetual.
Matt, to what extent does the market now believe we'll see an interest rate cut in Australia next month following today's inflation figures?
Well, it was a good inflation report for the December quarter. The trim mean gauge came in at just 0.5% for the quarter, and that brought the annual gauge down to 3.2, which is almost at the top of the RBA's target band. So the most important part of the report for households was not only the fact that it came in below the market's expectation, but more importantly, came below the RBA's estimate for inflation last November. And that saw the market increase the odds of a 25 basis point easing in policy to 100% for the next meeting at the bank.
Okay, that's what the markets think though, right? What do you think?
Well, monetary policy decisions are always about weighing up data, and whether it gets done in February or later really depends on whether the voters at the RBA are satisfied by the recent growth data, which has been soft, and this decline in inflation, or they're more concerned about our very tight labour market. But either way, I don't see a deep cutting cycle this year by the bank, as the prospects, I believe, for further disinflation in 2025 are pretty limited, given the fact we're seeing pretty large-scale depreciations of the Australian dollar, which obviously increases good import prices. And also there's a very tight labour market where wages growth isn't tied to productivity. And there's a government which continues to spend aggressively with the election coming up, just at the time the RBA is trying to slow things down. So at this stage, I see at most 2 cuts this year, probably beginning in February, but I think there's a pretty good case for it being delayed till May.
Okay, that's Australia. We've also got the US Federal Reserve meeting this week. What do you think it's likely to do?
Well, in terms of a degree of difficulty, I think this week's FOMC meeting really is a walk in the park relative to what the RBA has in front of them. With the US, you only really have to look at the strength of the US economy and its indicators that core inflation is not falling anywhere near as fast as what the Fed voters were expecting to really understand why rates in the US are likely to stay on hold. They're not really going to say much, I think, to markets, given all the uncertainty around Trump's trade policy. And what I would say, though, is that given that backdrop, I would argue that if growth and inflation, these trends continue, I think the Fed is pretty close to being done with their easing cycle. And I think the debate by the end of this year is probably going to shift from are they going to ease to when could the next tightening be? And that would be quite a shift for the markets.
It's been quite some time since you and I have chatted, quite a few months. In that time, we've had a big change politically in terms of US President Donald Trump coming into power. His presidency, does it change the way you invest?
Certainly not. Our investment approach is steadfast, and it's not really impacted by who resides at 1600 Pennsylvania Avenue in DC. We remain pretty cautious at this stage. There's a bit more uncertainty around Trump and his trade policies, that's for sure. But more importantly, the caution really reflects the markets are expensive at the moment, and they are priced at levels which I would argue are above even perfection. And what I sense is going to occur this year, unlike the last 2 years, I think returns are going to be pretty low, modest, low single digit, and the markets are going to be quite volatile. And I think sometimes markets just need to catch up with where expectations are, and that is probably what's aligned for investors this year. But they've had 2 great years of returns, so the question really is, what would be the catalyst for another major leg up? And I find that pretty hard to fathom at this stage.
Okay, final thing, and speaking of volatility, the big story yesterday was that global sell-off in technology stocks following China's move into cheap AI models. Many of these stocks have largely recovered those losses overnight. So was it a knee-jerk reaction, do you think? And what's your take on the whole AI tech space?
Look, I don't think it was a knee-jerk reaction. From what you could see from DeepSeek, that could be very disruptive for the US tech darling called NVIDIA, which is which obviously distributes its chips. Now, NVIDIA started 30 years ago, I believe, really designing computer chips for nothing more than computer games. Now, obviously, more recently, they have evolved quite successfully to being really the poster child for artificial intelligence. But this China firm that's been mentioned in the last few days, if they can do even half of what they say they can do and at the price they can, now that to me is going to be highly disruptive. So I don't think it's a knee-jerk reaction. There may not be much more reaction for several months because at the moment we're in a bit of an information vacuum. But my suspicion is you've probably seen peak valuations for this firm. Competition comes in, lowers the price, that hits your revenue line and your profit line. And most importantly, investors don't want to pay record high valuations for that kind of earnings backdrop. So my suspicion is NVIDIA will, still be a leading company in the AI space, but I think that its valuation is probably going to decline from here, and that was always going to be the case. Stocks cannot hold these type of valuations indefinitely into the future, and there just needed some uncertainty around its earnings outlook and what the path ahead was, for all of a sudden to investors to, perhaps look for other opportunities in the AI space.
That's Matt Sherwood there from Perpetual.
This SBS On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.